What you need to know about the government shutdown in this week's Fastest 4 Minutes in Finance. Hello, I'm Scott Inman. October is a seasonally weak month for the stock market, and with the indexes at all-time highs, it's really been remarkable so far that investors have largely shrugged off worries about a government shutdown that started on the first of the month. That could be because we're numb to it. It's happened in 1995, 2013, 2018, and the list goes on. It happens when Congress fails to pass budget bills. This time, the hang-up is over healthcare subsidies, Medicaid funding, and other budget trade-offs. The Senate needed 60 votes for a short-term funding bill and didn't get it. The impact of a partial government shutdown is immediate and can be more detrimental the longer it drags on. The shutdown in late 2018 lasted 35 days. Here are 3 things you need to know about how the government shutdown could impact you. Number 1, Social Security checks don't stop. Social Security, as well as Medicare and Medicaid, are mandatory spending programs funded independently of annual appropriations, so benefits continue during a shutdown. However, the administrative side is affected because some workers could be furloughed, which could delay things like benefit verifications or the issuance of Social Security cards, and some offices could even be closed. Number 2, there could be increased market volatility. The market doesn't like uncertainty, and the longer the shutdown lasts, the more investors could get jittery. Economic sectors more closely tied to federal spending could be hurt more. And some economists warn that if the shutdown drags on, it could also complicate the Federal Reserve's policy decisions due to delays in key economic data. And number 3, the economic implications are real. A shutdown interrupts the flow of paychecks for government employees, and that could have a very real impact on consumer spending. Some analysts warn that each full week of a shutdown could shave 0.1% off of GDP. It also weighs on our confidence, the confidence in our government functioning, which can raise long-term borrowing costs. Bottom line, the length of the shutdown will determine the severity of the impact. And if it drags on, the economy could slow even faster than it already is. Stocks could experience more volatility. Your account balances could take a hit. But as we always say, short-term volatility is the price we pay for long-term growth. Stick to your plan for financial independence and don't make a bad long-term decision because of a short-term risk.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.